Hello and welcome today to Trading Covered Calls and Cash Secured Puts, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Barb Armstrong. Barb is a 20-plus year veteran of the financial markets. She's a great instructor, and I urge you to seek out her webcasts as well. She's going to be there helping out to answer the questions that come into the chat. For those of you that are here with us live, welcome to you. You have the opportunity to chat with Barb and myself live in that chat. For those of you that are watching the recorded version of this webcast, we're glad to have you with us as well, for sure. Your conversation begins in the comment section of the description of the webcast. So leave us those comments. We'll get back to you as quickly as possible. So I'm grateful for the opportunity to step in today and fill in this webcast for my good friend Cameron May. And for a lot of different reasons. One of those reasons is that on a regular basis, I get to teach this particular topic of covered calls when we are teaching our technical analysis and option strategies workshop live. And as a matter of fact, we did this a couple of weeks ago in Denver. And we're going to have this opportunity to do it again coming up in Boston in a couple of weeks in the the technical analysis and option strategies workshop. So I wanted this opportunity to address a couple of the questions that come up on a fairly regular basis. We're going to try to work through some of those questions, including the question of, is it better to sell further out in time and further away, or shorter dated and more frequently? So we'll see if there is perhaps a clear advantage, and if there's not, maybe what some of the considerations might be. But a couple of quick housekeeping items today as we get into this discussion. Remember that everything we talk about is simply for illustrative and educational purposes only. None of it should be considered to be any kind of a recommendation or solicitation or advice about a particular security or strategy. Remember that options carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. So we're going to be talking about technical analysis as part and parcel of this strategy, and the ones that we're going to talk about in this discussion today will incorporate an element of that. Remember that technical analysis is theoretical in nature, as is fundamental analysis, as is probability analysis. None of those are guaranteed to determine what the market is going to do. They are, as I said, theoretical in nature. Schwab doesn't recommend the use of technical analysis or really any one sole method of investment research. We're going to talk a little bit about this idea of the possibility of being assigned on a short option. Remember that anytime a trader is short an American style option, there is the possibility of being assigned early that obligation that exists with that short option. So we'll talk about the characteristics of that, the likelihood of that. Now, we're going to be using the Thinkorswim desktop software platform today, in particular, the paper money version of that platform, which does not allow for the early assignment of short options. So that's something that you need to be aware of as you move your practice to live trading from paper trading. But the paper money platform is a great learning environment. It's a great sandbox in which to play. So it's a good opportunity to take advantage of the characteristics and the tools and the mechanics of the Thinkorswim platform as you learn to trade. Also, a couple of other things. There are other performance issues of the paper money platform that don't match up with a live trading platform, namely in the area of order fill prices. Typically, the paper money platform will fill at the midpoint, where in a live account that may not, in fact, happen. So that's something to be aware of. While we're on the topic of order fill prices, one thing to remember is that when a trader places a stop order that generates a market order, there is the possibility that that market order may fill at a substantially different price than the trader intended. Number two, with a stop limit order, there is the possibility that the order may not fill at all in a fast-moving market, and the price gaps around that protection area. So when we talk about covered calls, It's important to remember that annualized returns may not occur. You may not be able to annualize or generate the returns expected over a period of time because market conditions do change. So those are things that we need to pay attention to. Let's pop over here to the Thinkorswim desktop software platform. I've got an example of a potential buy right strategy that I wanted to jump into right off the bat, simply to kind of get us going, get the juices flowing when it comes to covered calls. Because to be fair, covered calls, for the most part, aren't really I don't want to say they aren't really an exciting strategy, because exciting implies that, wow, exciting is what we should be looking for. But covered calls are a methodical strategy in many cases, in that application of the strategy is intended to offset a lack of price appreciation. And so it's used as a replacement strategy, not as necessarily a speculative strategy, depending on how it's put together. But this is a circumstance that came across as I was looking at these trade opportunities and ideas, again, illustrative examples of those, not recommendations, that may present kind of that speculative potential. So some traders may look at trading, say, for instance, going long the stock and then putting a price target level as a take profit order. Well, putting that price target level or putting a take profit order in place just as a limit order to sell the stock at a particular level may work, and it may get the trader out of the trade at a point in which they want to get out of the trade with that expected move, if they're a shorter term swing or intermediate term trader, for instance. But it doesn't necessarily pay anything, and it doesn't necessarily offset any downside movement. So a trader could, in this particular example, looking at TJ Maxx, which is in the retail sector, and it's banging its head on this resistance that it's bounced into once, twice, three times here. And it's acting as if it's in an ascending triangle, one of those price patterns that we've talked about before, with that potential to break out. A trader could look at entering the trade on the breakout and then selling when it made a move to the measured move from the price pattern, or a particular level, or particular Fibonacci level, or a number of different ways in which you could look for an opportunity to exit the position. But we're going to treat this as a buy right strategy. When we buy the stock and we sell the covered call, and we're intending then to use that covered call in place of that take profit order. In the event that the take profit order doesn't get hit, meaning that it doesn't get to that level and we don't get called away if we hold it all the way till expiration, at least we're generating some premium or collecting some premium for the sake of taking that opportunity on that breakout. Now, it may offset some downside movement. So the idea being here, and let me add a little bit of room to the top side of this chart really quickly here. So I'm going to just go to my price axis. I'm going to add about 20% to the upside so that we can kind of see this range up here. And what I'm going to do is I'm going to take a conservative, now, a number of different ways. By the way, my good friend Rachel Deschelle, one of our great coaches, teaches, I think on Tuesdays, trading price patterns. And she does a great job in talking about how you come up with the measurement objectives for a particular price pattern. So one of those ways is to simply take the width of the base of that triangle and then project it forward. So I'm going to do the same thing. I'm just going to take a more conservative approach than some traders might take. Some traders might come back down here and go to that resistance level. I'm going to go to this last kind of big solid touch and bounce off of that diagonal uptrend line. And I'm going to use that, and I'm going to right click and duplicate. And I'm going to put that up on top of that breakout potential. I'm actually going to adjust that a little bit here because it just kind of scooted up. And I'm going to take that area right up here on the 171 mark, and I'm just going to draw a line. That's that potential move based on the projected measurement objective of this particular price pattern. So why is that important? Well, that's an area where there is likely to be potentially some resistance. There's no guarantee of that. In fact, if we look back, on a longer term chart, and it's always good to check left to confirm what's going on right, we can see that this is moving out to now 3-year highs at the very least. In fact, this may in fact be an all-time high. So to project a level of resistance overhead in a stock that's never been to that level before becomes an imperfect and an imprecise game. So this is simply one way to go about doing that, is through that measured move. Fibonacci's would be another way, symmetrical moves, percentage moves, a lot of different things, expected moves from the market. So here we are at about 162 and we're about 172. So that's about a 10-point move to the upside. That's an important consideration, the fact that this has about a 10-point move possibility to the upside. Now, the other thing to think about is how long might it take to get there? And again, going back to that price pattern perspective, the length of time that it takes to create the pattern is oftentimes the length of the time that it takes to get out to the target. That's kind of generally accepted technical analysis price pattern theory. We don't have a nice, concise acronym for it like the accounting world does when they call it GAAP, generally accepted accounting principles. I don't know, maybe we could come up with something, Barb. Generally accepted technical analysis principles, GAAP-P, I don't know, something like that, right? But this is taking about 2 months to get to where it is in this price pattern from this standpoint. So it may take about 2 months to get out to that target, that 10-point target, which then logically suggests to me that if we're going to expect that this is going to move 10 points in 2 months, maybe it moves, and it doesn't always do this, and this is no guarantee by any means. Maybe it moves 5 points in 1 month. So if we think about that, that may give us an idea of how far it might move in a shorter time period. If we don't want to sell a covered call out 2 months in time, and we want to go to a shorter term perspective, then in that particular case, we might look at just a shorter time frame and take half the move. Now, is it a linear equation that gets us out to that? I don't know. It may be logarithmic or exponential in some case, where we get a bigger move, especially if we have an earnings announcement over the horizon that might cause that bigger move. I like heuristic principles, yeah, for sure, Eric, because that's what we're doing. Is we're taking a heuristic which says that price may move this distance, and we're applying it. So yeah, I think generally accepted heuristic principles. Yeah. So that's my point, Mark. You nailed it exactly, right? You nailed it exactly. So 1 month out is about a +5 move, plus or minus 5 move, and out to May is a ±9, right? So that's what I'm saying. It may take that 2 months worth of time. So where are we getting those numbers, that expected move that Mark just referenced? I'm going to come back over here to the trade tab. And we're going to look over here on the right-hand side, and we're going to say, look, here's the May expiration. That's about a month from now, right? 32 days to go from now. There's the May expiration. Come over to the right-hand side. That's about a 10-point move. So there we go. That's kind of cool. The fact that it's got about that 10-point, that's actually a little bit faster than I had anticipated, right? So I was looking out actually, in fact, 2 months, maybe out here closer to the end of May, and we were getting about an 11 or a 12-point move. If we were to go even a little bit further out, we go out to the 18 June expiration, which we don't. Soon we will have some additional weeklies out there, but that's about a 15-point move to that distance. So I'm kind of comfortable with this perspective of going out a month and looking for that move. Now, the next question to ask in this type of a buy right strategy, where we're going to be buying the stock and then we're going to be selling the call option at the same time, in terms of getting to that potential move, where our intent is to be called away, to be called out of the stock. That is entirely the intent of this particular trade. That is our expectation. That is the intent of putting this trade together, so that we're not holding on to the trade. But if we don't get called away, great. we do it again the next month. So I'm going to actually kind of zero back in on that 8 May, because a 9-point move to the upside here or to the downside, because this is an absolute value, right? It's plus or minus. That 9-point move, absolute value, would put us at a slightly attenuated target from where that price target is from a technical analysis basis, which is I'm just fine with that. You notice I did two things here. I attenuated the move by going to a smaller distance on the price pattern, but I used the entire length of time, right? And I'm attenuating the move by saying, hey, this might move 9 points given what the market expects. Now, the other thing that I know too is that these implied volatility based moves, this number over here on the right-hand side, oftentimes tends to be a little bit over exuberant. The market gets a bit ahead of itself because this number comes from that implied volatility. That implied volatility comes from both speculative bullish and speculative or protective bearish trades. So it tends to get a little bit out over its skis, to borrow a Barb Armstrong term. And by the way, I don't know if you knew that Barb Armstrong used to be a ski patroller and is a bit of an expert when it comes to the skiing type of activity. But right here, we're going to go to that 8 May. We're going to open up that expiration, and we're going to go over to the call side. Now, one of the things that I want to do is, in this particular case, I want to focus on just one side, the call side of the equation. And one of the questions that comes up is, can I filter my option chain? And this is something that I like to show here. It's oftentimes difficult to do when I'm teaching in the workshop environment live on stage. But what I'm going to do is I'm going to come up here to the top where there's that filter, just in the top of the option chain. And I'm going to click on the filter. And since we're talking about covered calls, I'm going to filter this just down to the call side. So I'm going to click on side, and I'm going to filter that just to the calls. And now my option chain is just focused on calls. I'm not looking at any of those put options at this particular case, right? So that's where I'm going to focus. Now I can narrow down what I display in the option chain in terms of days to expiration and strike prices. I'm going to leave those filters alone for the moment, just in this particular case. And by the way, Mickey says, hey, great stock, not many open interest options here. So we might be paying a little bit more in terms of slippage, in terms of the trade. I'm not terribly worried about it, in that there's a fair amount of implied volatility. I know that market makers will list new options, and in fact, that's what we're going to be doing is we create this. Yeah, and good point, Mark. Very good. So, and we're going to create this, since we're writing the premium, we can wait a little bit for that premium. We're writing the contract. That's what a buy right strategy is. So we're essentially creating some of that open interest in this particular case. Now, whether somebody buys it from us at that price, that remains to be seen, and whether there's liquidity there or not. So I'm noticing that, yeah, in some cases, especially right at the money strike, there's a fairly wide bid-ask spread here, in this case, out of the 32 days to go until expiration. And to Barb's point, that is, and to Mark's point, these are fairly new off the assembly line weekly options, right? So these have not been traded very much. But notice something here. The at-the-money strike, which has the greatest amount of extrinsic value, and you would think because of that greater amount of extrinsic value is going to have the greatest amount of interest, and because it represents the kind of the 50-50 proposition, is going to have the tighter bid-ask spread. But in this case, that's a dollar-wide bid-ask at the money strike. But notice something right here. We go out to the 170 strike. we've got what, about a 40-cent bid-ask spread. That's tightened down a fair amount. And so that's kind of given us that range here. That's giving us a little bit better liquidity in terms of that bid-ask spread and a little bit less slippage. So let's go back to our chart and let's see where that is. That's going to put us out to the 170 mark. So we were looking at about 171 at a 10-point move. We look down at 170. That's kind of right about that 9-point move, isn't it? That expected move. Do you suppose, I'm just asking this question hypothetically, and you can take it as rhetorical, or you can give me an answer, what you think. Do you suppose the fact that there is a tighter bid-ask spread and more liquidity at this 25 delta at the money, or not at the money, but out of the money strike, but at really kind of falling right about where that expected move is? You see what that expected move is right over here? Do you suppose there's some correlation between a tighter bid-ask spread, more liquidity at this 170 strike, and the fact that that's about where that number falls, and that's about where that price pattern puts our price target? Do you suppose that all three of those things are somewhat in some way interrelated to one another? I suspect there might be a reason there, because that's what the market expects, and that's where the market is trading some activity here. If we were to change our layout from our option Greeks to just very simply, let's go volume and open interest, you can see that, wow, well, you know what? That's about the point at which there is the most. There's about 3 contracts there. But again, remember, these are brand new. So that's the reason, perhaps one of the reasons why this is maybe the most liquid. This is, and to be fair, I was looking at this stock based on the breakout. But that being said, there's where we are. That's where we currently sit. So I'm going to come back to our option groups. I'm not terribly worried about it in this particular case, because I know that we're trading this as a buy right. I'm willing to wait a little bit for this to get filled. And I've got a reasonably tight bid-ask spread. I'm not looking for a particular percentage difference between that bid and ask. So we could create an order where we buy the stock and then turn around and sell the option, or we can come up here to the spread and I can change this to covered stock. And that's oftentimes what traders will do in the Thinkorswim platform when you initiate a covered stock position. That is a covered call, essentially. So we know that we're going to sell that 170 strike. That's what we were looking for. So we're going to come over to the right-hand side, and we're going to see that that is a fairly narrow bid-ask spread, all things considered. Remember, I'm going to be buying this, so I'm going to be clicking on the ask, because the stock is more expensive than selling the call. So this is going to be a net debit trade, and we're going to look at buying the stock for a net cost of 160.63 versus where it's trading at 161.98. So the potential gain is the price of the stock going to 170, having the stock called away. So as we click on that ask price here, and we go through this order, this is creating an order to buy the shares of stock and sell the 170 call for a net debit of 160.40. Click on confirm and send, and we can see what our maximum profit is on the trade. That's buying 100 shares of the stock, selling the covered call, and bringing in that premium. So the cost of the trade is going to be the cost of buying the stock, but we were willing to do that anyway if we didn't own it in the first place, because it's covered call, and we're creating this as a buy right strategy. So there's the potential to make that money in this trade. Now, there's also the potential, because we own the underlying stock, to lose money in the trade if the price of the stock goes down. But that gives us a break-even price that is more than $1 below where the price of the stock is currently. So we're giving ourselves a little bit of a buffer here in ownership of the stock if we enter the trade. Doesn't mean that you can't lose money in the trade. And below $160.42, this becomes a losing trade. in that you're losing more money in the premium or in the ownership of the stock than you received in selling the buy right covered call. So I'm going to go ahead and I'm going to click on send. We're going to put this in our cash secured puts and covered calls section. And we may have to wait a little bit for this to get that price because we traded it as a limit. We're trying to work it to that limit price here. Or we traded this as an order to try to get inside that price a little bit, kind of working a little bit. If that doesn't fill right away, again, that's going to be one of the things that we can come back here and we can say, look, we can go to the monitor tab and we can work that order a little bit by right clicking, canceling and replacing, and we can kind of work this order in a little bit, being willing to give a little bit more. We were just inside that midpoint. Our limit was set at 160.43. The mid right now is at 160.52. So we're trying to work inside that midpoint. Now, there are two ways that we can do this. We can be patient and wait for that to come to us, or we can increase that limit a little bit and maybe take that outside that mid or to the mid. Remember, in paper money, it's typically going to fill right about at the mid price. And we're going to go ahead and click on confirm and send, read through this order, make sure that that's what we want to do, put it in our cash secured puts and covered calls strategy section. And by moving it out a little bit, by bumping it out to the midpoint in paper money, we got that order filled. The question is, how would that fill in a live account? Well, I don't know for sure. Until that is hypo tested in a live account, you're not going to know for sure, but that's a circumstance where a trader can work that order a little bit to try to get it inside that bid ask, especially if bid ask spreads are wider on the option. That gives the exchange and the market maker a little bit more flexibility in terms of filling that order by moving it around a little bit. You notice that our spread tightened up. It was at 160. About 160 bid by 160.55 some odd offer, and it tightened up a little bit now as that market begins to move a little bit here. So that's how we would go about putting together a buy right strategy trade. And now we've got the trade. Let's go to the monitor tab. Let's go to our cash secured puts and covered calls section, and here is our TJ Maxx. Brought in that 147. It's actually started to go against us on the call side, for us on the ownership of the stock side, because it's gained a little bit in the price of the stock. The stock's gone up a little bit. So that's, in fact, kind of doing what we expected it to do. We've got to be willing to recognize this. Here's the thing. For a lot of covered call traders, they're going to start to look at this and say, well, we sold that covered call for $1.47. It's now trading at 152. That's working against us. But you got to remember, the intent of a buy right is to have the stock called away. And having the stock called away is the end game for that buy right strategy, theoretically, in this particular case. Now, could a trader decide, wow, this is running significantly, I want to keep the stock, buy back the call? Yeah, I mean, that's, the flexibility of a buy right covered call is that it allows for that circumstance to buy back the short call, hold on to the underlying stock and let the stock run if it looks like the stock is going to run. But if the intent is to set a particular price at which we expect the price of the stock to be called away, or the underlying stock to be called away, this buy right type of strategy is one that can work in that particular range. So the other thing I wanted to go through real quick while we're talking about these things after this buy right strategy is the comparison and the question about the possibility of selling covered calls. So I've got another strategy here. I've got another position. I'm going to go back to my monitor tab, and I think I've got, if I go back in here, I've got 100 shares of Coca-Cola. I'm going to move this to my cash secured puts and covered calls group here. So I've got 100 shares of Coca-Cola. One of the questions that oftentimes comes up in evaluating covered call strategies is it better to sell one longer dated call option, bringing in more premium, but holding on to that trade for a longer period of time, versus being more active and selling more frequently for less premium. So I wanted to kind of set this up, and I've done some just kind of the back of the napkin evaluation here on this. With that back of the napkin evaluation, that kind of gets me to this point of understanding how we're going to put this together. So what I'm going to do is I'm going to go to the trade tab here for Coca-Cola. And we're going to look at really kind of a comparison here. So the comparison is going to be this. We're going to look at selling the 8 May expiration. And we're going to look at comparing something that is just under 2 weeks to go until expiration, and that's the 17 April. So we're going to compare the 8 May weeklies, and we're going to compare that with the 17 April regular expiration options. So $2 move or $2.43 move in the 17 April expiration, and we go out to the 8 May expiration, and we've got about double that, just under double that move. Implied volatility goes up a little bit as we go a little bit further out, likely because we're getting out to a potential earnings announcement there somewhere in this 1 May to 8 May timeframe. We've got a little bit of a bump of implied volatility that tells me where that next earnings announcement is likely to be. So let's go first out to that kind of general area where many, not most, because I don't know most, but many covered call traders will begin their search for a covered call out around a month worth of time, maybe a little bit more, and around the 30-cent delta. So we're going to go out to the 8 May timeframe. And we're going to change this back to singles because we don't want to do covered call. We don't want to do a buy right. We want to do a leg in because we already own the stock. So we're going to look out around the 30-cent delta. That's going to be about the 80 strike. And that's going to bring in this case, about 85 cents or so midpoint between the bid and the ask. So we're going to bring in about 85 cents. So we're selling out a little bit further in time. So that's the one that we're going to compare. I don't need 120 strikes. Let's go back down to like 12 strikes so that we've got that kind of narrowed down in our focus. Because I think what we can do is we can probably compare the two of these side by side. So let's go to the 17 April. And let's go out to about that same strike price. But here's the thing. We go out to about that same strike price where we're getting a lot less premium. So if we go to the 30-cent delta, roughly, that's going to put us at about the 78 delta, or excuse me, the 78 strike versus the 80 strike. So here's the thing. If we were going to kind of compare these apples to apples, we're kind of getting to the same thing. If we're using delta as kind of the approximation. So the 80 strike, same probability, roughly is the 78 strike, probability of being in the money at expiration. But we're getting about 20 cents less premium by selling 11 days out. Now, other comparisons that we need to draw here. If we take a look, let me grab my magic marker and we'll just kind of line these out. So roughly similar deltas, okay? We could even come in a little bit on the longer dated one just to see. But notice that the one here, let me grab this pen and see if I can get this a little bit smaller. There we go. Okay. So notice that we've got about double the gamma sensitivity out in the shorter dated option, but Mark kind of recognized this. So we've got about 3 cents theta here, and we've got about 5 cents theta here. Greater time decay. We're able to gain more time decay efficiency, if you will, selling shorter dated. Roughly the same, about 3 cents, 2 cents less, 2 or 3 cents less Vega sensitivity. So not worried necessarily about implied volatility, but volatility, remember, Vega gets smaller. The Vega influence gets smaller the closer we get to expiration. So this is an option that has roughly the same directional sensitivity. It has just about double the gamma sensitivity. Now, that may be the concern and a consideration point here. but it's got greater theta, so it's decaying away faster. And so we're really not gaining that much more efficiency, though, if we do that twice, right? So here's the challenge, right? So if we were to do this every 11 days, right, that could theoretically yield, if you think about that's about maybe 1% more, maybe 2% more premium. If we were to look at this premium versus this premium, that's maybe 2 or 3% more premium if you were to analyze that, or excuse me, annualize that. Then selling the time decay or the further out in time option. Theoretically, we would realize more. Now, both of these assume that we're holding these till expiration, which we theoretically would not necessarily do. But if you think about this, because of that greater amount of time decay, the advantage perhaps on a yield basis, if we want to think about it, maybe swings to the shorter dated one, doing it a little bit more often. So we'll put a plus over there and we'll put a minus over in this one, right? So in terms of total return potential, okay? If we think about the mitigation of risk and drawdowns and the amount of premium, we're getting a little bit more in terms of outright protection against drawdowns from the greater amount of premium a little bit further out in terms of time. We're giving it a little bit more absolute premium to offset a downside move. So the advantage maybe falls to the longer dated option. Okay. So if that's where we are now let's talk about theoretical assignment risk versus the short dated versus the long dated. So if we're doing this every 11 days and we're doing this every 32 days, that means we're doing this about 2 times as often, which means that we would have potentially in the shorter dated expiration, we would have potentially 6 to 12 possible assignment risks per year if we were going to continue this over the course of a year. So that is more potential, greater potential for early assignment. Now, if that's your goal, great. If that's not your goal, that presents a bigger challenge. So I'm going to make that idea kind of a neutral to minus for the shorter dated and kind of a neutral to plus for the longer dated, because there are fewer assignment risks potentially for the longer dated option, right? You think about if you're doing that every 30 days or so, think about that. That's maybe 3 to 4 assignments that you might take every year, just in terms of that. So the other thing to think about is more frequent expirations. If you're expiring every 11 days and you're doing that again and again and again, that is significantly more decision points than the longer dated option. You got to be more on top of managing that particular trade. So thinking about it from that standpoint, that maybe falls as a negative for the shorter dated, and maybe a positive for the longer dated, right? Fewer decision points, fewer risks of execution error. Yeah, assignment would be the equivalent of selling the stock, RB. You're exactly correct, right? So, and again, we're not tax advisors, so we don't even play them on TV, but more opportunities to have the stock called away creates more opportunities for taxable implications if those exist in this particular case. So that may be more shorter term taxable events. So that kind of falls against the shorter dated option. Now, let's think about theta and time decay, the inevitable, right? Those 14-day calls have a steeper rate of time decay. We looked at that right here. So that would be a big positive for the shorter dated options. And that would fall as a negative for the longer dated options. And so you can kind of think about it that standpoint. Now, that being said, as we get closer to expiration, if the price of the stock were staying neutral, right? The price of the stock were staying sideways, what's going to happen to this theta number on the out of the money option, the further out of the money option, because we've got a 78 strike versus an 80 strike. This 78 strike is going to accelerate faster than the 80 strike as we get closer to expiration. Because remember, there's that time decay curve. Let me grab this real quick. Let me just do this, see if we can do this really fast. I don't know if I can do this. Nope, it won't let me do a whiteboard. Okay, let me just talk through this real quick. Because you remember our time decay curve that looks like this? That time decay curve exists at the money strike. But when we go further out of the money, what happens to that time decay curve is that we get a greater acceleration initially, and then it flows into a slow mode. So that would perhaps preclude the longer dated option from getting that bigger rate of time decay. So I'm still going to go with time decay getting a positive for the shorter dated and a negative for the longer dated option. So let's kind of crystallize this really quickly, because they're just about even, almost. We got a 2-to-1. Well, let's see. We got 1, 2, 3 minuses versus 2 minuses, and we've got 2 pluses and versus 3 pluses. So how do we? I mean, that's not really a tie. That kind of shades us towards the longer dated option from that perspective. But something to think about is this. The 14-day option, or the 11-day option in this particular case, since we have an 11-day expiration, might benefit more active traders who are willing to put the attention into this, managing it to get that larger 2 to 3% greater yield theoretically, and feel comfortable with more frequent management. The 30-day option may appeal to investors who are looking for a little bit more simplicity, don't want to manage it as frequently, don't want to worry about as many assignment potential occurrences for that circumstance. So there's not really a one best answer, ultimately, is what it comes down to. I just wanted to kind of talk through some of those ideas here. So let's do this really quick. I want to do this really fast because I want to kind of practice this and use this as a teaching example. I'm going to kill those annotations. I'm going to come back over here and I'm going to sell, since I already own the shares of stock, I'm going to go ahead and I'm going to sell one of the 11 days to go until expiration. Whoops. I hit the wrong. So we go to the 78 strike here. We're going to sell that one and I'm going to fire that off. We're going to put that in our covered call group and we're going to send that off. And I'm going to do the same thing for the 80-day or the 80 strike, the 32 days to go until expiration. We're going to click on confirm and send. We're going to send that into our cash secured put range, and we're going to send that one off as well, so that we've got both of those to compare and contrast. So if you want to learn a little bit more about this, I know this was a little bit deeper discussion and dive here in consideration. But if you want to come over here to the Trader Talks webcast page, this is a great opportunity for you to learn more about covered calls. I'll just type it in, calls, right there. You're going to see the entire list of the playlist of covered calls and short put webcasts. You're going to see all of those considerations, including a beginner's guide, because we jumped kind of right into the middle of all of this. So if you're brand new to this strategy, this is a great place to go to learn a little bit more about it. All we ask is that you click on subscribe right there. That's going to make sure that this becomes easier for you to find. Also, click on like if you happen to enjoy this webcast today. And once again, my thanks to Barb Armstrong for helping out. My thanks to all of you for participating in this discussion and being part of this conversation. My thanks to Cameron May for letting me have the opportunity to do this. Guys, thank you very much. And we will see you again very soon. Take care, everybody. Bye-bye.